Okay, welcome back. In this series, we're going to talk about inventory and how to record inventory from an accounting perspective and financial accounting. Okay, let's talk about inventory control. We all know that inventory are the goods that the business sells to customers. That's inventory. Let's talk about how do we control inventory. There are two primary objectives for controlling inventory. Number one is we need to protect, safeguard our inventory from damage or theft. And we also need to report inventory in our financial statements. These are ways that we control our inventory. So safeguarding. We have controls for safeguarding inventory as soon as the inventory is ordered. We have what we call our primary documents. In accounting, we have primary documents to track our accounting process. For inventory, this includes things like the purchase order, the receipt that comes with the inventory, and the vendor's invoice. Now, as a financial controller, the way that I commonly pay my invoices is I take my purchase order, the receiving report, also known as a packing slip, and the invoice. I staple those three things together. I print out the check that I'm going to send to my vendor. I sign the check, make copies of those documents, file them away, and send the check out in the mail. The reason I do that is to show a control process of controlling the process of making those payments. The purchase order authorizes the purchase of the inventory from the approved vendor. The receiving report, this is also known as a packing slip, establishes the initial record of receipt of that inventory. So the packing slip or the receiving report, that's what you find in the box. You'll typically find a piece of paper and it'll show you what is in that box, right? That's the packing slip or the receiving report. Typically what you'll find is the price, the quantity, the description of the items are on the purchase order and on the receiving report. You compare the two, make sure you get a physical count. What is on there is what you actually received. You sign off on it and file all that good stuff away. And then later on the mail you get the bill, right? Recording inventory in a perpetual inventory system is an effective way of controlling it. This amount of inventory is available in the subsidiary inventory ledger, which we learned about in the last chapter, in chapter 5. Controls for safeguarding inventory should include things like security measures for preventing damage or theft. Examples would be like storing inventory in areas that are restricted. In other words, in like a locked door, behind a locked door, in a safe, in a cage, areas where only authorized employees are allowed to be, right? You want to use things like security cameras, two-way mirrors, security tags, guards, you name it. There's a number of wonderful ways to protect your inventory. With physical inventory, we want to take a physical count at least once a year. Sometimes I do it twice a year. Larger companies do it twice a year or once a year. Smaller companies might do it like once a quarter. It's where you take a physical count of all of your inventory and make sure what you have in your computer matches what you actually have on your shelf. Okay, that's what we call physical inventory. After the quantity of inventory in hand is determined, the cost of the inventory is assigned for reporting in the financial statements. Okay, here's a flow, a cost flow. Now, some companies, you should select one and stick with it. Okay, there are three types of cost assumptions, and to value your inventory, you should select one of these and stick with it throughout throughout the whole company. If you change it, it can be quite costly. The first one I want to talk about is the first in, first out method. This is the cost flow in which the costs were incurred. First in and first out. What does it mean? I received this inventory from my vendor first, and I'm going to sell that first. First in and first out. Think of a grocery store. They got it, the first gallon of milk, put it on the shelf. That should be the first gallon of milk sold because it's perishable. They use a first in, first out inventory method. The second one is last in, first out. The cost flows the reverse order in which the costs were incurred. So Macy's might use this example, or there's a couple of companies that use it, right? They get the inventory in from their vendor, and then they get another batch of inventory in from their vendor. That last batch is the one that gets sold first. Last in, first out. And then the third one is the weighted average cost. This is the cost flow. This is the where you just take the average of the costs. So let's look at it from an example. Let's assume that we have 3 identical units of merchandise that we purchased during the month of May. We purchased inventory on May 10th, May 18th, and May 24th. On May 10th, the inventory cost me $9. On May 18th, the cost was $13, and on May 24th, the cost was $14. This gives me, and I only purchased 3 things, right? But at different costs during different times of that same month. The reason why the costs are different is because maybe the fuel cost changed during the cost of shipping. Maybe the raw materials that we purchased the inventory from changed throughout the month. That's why there's different costs. Or maybe I purchased them from 3 different vendors, but it's the same exact thing. Okay? So May 10th it was $9, May 18th, $13, May 24th, $14. I bought 3 units. The total cost of all 3 units was $36. This gives me an average cost per unit of $12. How I got there, I took the 36, I divided by the 3 units to give me an average cost per unit of $12. That's where you take your total cost and you divide it by the total number of units to get you an average cost per unit. Now let's assume that 1 unit is sold on May 30th for $20. Depending on which unit was sold, the gross profit varies from $11 to $6, and the ending inventory values range from $27 to $22. Here's why. We sold that 1 unit for $20, which May 10th, May 18th, May 24th. The cost of goods sold, as you know, is different each time. May 10th was $9, May 18th was $13, May 24th was $14. You take your sales minus your cost of goods sold to get your gross profit. 20 minus 9 is 11. 20 minus 13 is 7. 20 minus 14 is 6. Your ending inventory is 27, 23, 22. Okay? How we got there, you took your 13 plus your 14, your 9 plus your 14, your 9 plus your 13. Again, averages, right? The reason why there's so many differences is because we have 3 different methods of assumptions. First in, first out, last in, first out, weighted average inventory. Under the specific identification inventory cash flow method, the unit sold is identified with a specific purchase of the ending inventory made from the remaining units on hand. So let's see how that looks. Under the first in, first out method, my first purchase was on May 10th. I sold it for $20 using the first in, first out method. So 20 minus the $9 gives me $11 gross profit. For my inventory balance is $27. How I got there is 13 plus 14 equals 27. Because remember, first in, first out. I sold that $9, so therefore my remaining balance for inventory should be what I purchased on the 18th and the 24th to give me 27. Under the last in, first out method, I sold it for 20. My cost of goods sold was 14. Why 14? Because under last in, first out, my last purchase of inventory was $14. So 20 minus 14 gives me a gross profit of 6. So what about my remaining balance of inventory? It's 22. Why 22? Because $9 plus $13 is 22. I didn't include that 14 because I sold that 14. Weighted average. Under weighted average, my sales was $20. My cost of goods sold was $12. Why 12? It's because $12 is the weighted average cost. 9 plus 13 plus 14 divided by 3 is 12. So 20 minus 12 gives me a gross profit of 8. My remaining balance for inventory is 24. Why 24? My average cost is 12 times 2. Times 2 because I only have two units left. Give me 24. So, for those of you on the call, let me ask you this question. For this particular company, using which method would be best for this company to use? What do you think? Would it be first in, first out, last in, first out, or weighted average? Which inventory method would be best for this company to use? First in, first out, last in, first out, or weighted average? What do you think? Go ahead and unmute yourself when you're ready, when you think. Which one is best? You could also type it in the chat if you like. For this company, in this situation, would first in, first out, last in, first out, or weighted average be best?
I believe that is last in, first out.
Last in, first out, you think that one's best?
That's what I think.
Why do you think that?
Let me see. Gross first. Because the balance sheet inventory is just $22. It's less money.
That's a good reason.
Yeah.
Yeah, I like that. Anyone else? Okay. Osman, that's a really good reason. I like it. I would accept that as a good reason. The other one that I like the most here is first in, first out. And the reason why I like first in, first out is because the gross profit is the highest here at $11. But Osman's selection of last in, first out is also good because it has the lowest inventory balance. So, and then weighted average is a good response as well because it uses the average of all three, right? And that's a good reason as well. So when a company makes a selection of which method they're going to use, they compare the three to make the best selection. And depending on what the company's objective is, whether it's to have a lower inventory balance or whether it's to have the highest gross profit, that's how they make their selection. So very good, very good. And of course, it'll change throughout time, right? It'll change throughout time. Okay. Okay, let's talk more about first in, first out. First in, first out is a method used in a perpetual inventory system where the costs are included, the cost of goods sold, in the order of which they are purchased. This is often the same as the physical flow of inventory. For example, a grocery store shelves milk and other perishable products by expiration dates. Products with early expiration dates are typically in the front. In this way, the oldest products are sold first. First in, first out. Entries in perpetual inventory under FIFO. Okay, first in, first out. So this shows a record of transactions that have occurred over time. We can see when we made our purchases and our sales, and we can see the flow. We see the flow. This is what this represents. Under last in, first out. Last in, first out is used in a perpetual inventory system. The cost of units sold is the most recent. Last in, first out method was originally used by those rare cases in which units were taken from the most recently purchased units. However, for tax purposes, last in, first out is now widely used when it does not represent the physical flow of inventory. Now, just as Osman has selected last in, first out in this example, because it has the lower balance, that means the company is likely to pay less in taxes. So that's why last in, first out is actually very popular. And this is how that inventory flows. Now, the weighted average cost method is when the weighted average cost is used in perpetual inventory system. Weighted average cost method for each item is computed at the time its purchase is made. This unit cost method is used to determine the cost of each sale until another purchase is made and a new average cost is computed. This is called a moving average. And that's how this would look. Inventory costing methods under the periodic inventory system. On periodic inventory system, only revenue is recorded at the time the sale is made. No entry is made at the time the sale is recorded cost of goods sold. At the end of the accounting period, a physical inventory is taken, and that's when we compute cost of goods sold. Like the perpetual inventory system, cost flow assumption must be made at the identical units required during the period. Okay, at the beginning of the inventory purchases of this particular item, January are as follows. Here are the beginning inventory purchases made, ending inventory for the month. Here are the costs at each one. Beginning inventory, $20, $22.40, $23.30. We can see the costs systemically rising in the purchases, first in, first out. Physical count, January 31st shows 800 units on hand. Purchases, most recent purchases, 200 units gives 800 units, and then we compute the cost for each. Beginning inventory, 20,000 plus our purchases gives us cost of goods sold available for sale, 45,180 minus our sales, to give us cost of goods sold, $26,720. Last in, first out, as you know, would be kind of almost in the opposite direction. Cost of goods sold are going to be a little bit higher, which means our inventory balances will be lower. Weighted average cost of capital, weighted average cost method. Weighted average unit cost, we take our total cost of units available for sale, divide that by the units available for sale. So in other words, you take your total cost of your units and divide that by the total number of units. That will get you your average unit cost. What is the average cost per unit at the ending inventory? So we take our total cost divided by the total number of units to get our average. We take our average times the number of units at the ending inventory to get our ending inventory balance. Okay, comparing. It's very important for the business to compare the inventory cost methods. Okay, as a result of the three methods normally yield in different amounts for the following: cost of goods sold, gross profit, net income, ending inventory. Note that if the cost prices remain the same, all three methods would yield the same results. However, cost prices normally do change throughout time, as you know. So using the perpetual inventory system, in this example, we have sales of $39,000. The difference in cost of goods sold, gross profit, and then inventory are illustrated below. Sales, $39,000. Our cost of goods sold for first in, first out is $26,720. For weighted average is $26,900. For last in, first out, it's $27,200. How we got there? We take the cost per unit times the total number of units. Gross profit is sales minus cost of goods sold, gross profit, and our ending inventory. So we can see from this illustration, based on gross profit, the first in, first out method is best. However, in order to achieve the lowest inventory balance, last in, first out is best. Again, it really depends on the objective of the company. And here's how the differences look. This represents the differences for each. Okay, what else do I want to show you? Okay, reporting inventory in the financial statements. Cost is the primary basis for valuing, reporting inventories on the financial statements. However, inventory may be valued other than the cost in the following cases. The cost of replacing items in an inventory is below the recorded cost. We call this below market value. The inventory cannot be sold at normal prices due to changes in imperfections, style changes, spoilage, damage, obsolescence, or other causes. When you see this word obsolescence, this means that it is what we call obsolete. Obsolete means it's been replaced by a more updated version of that product, and so it becomes obsolete. It's kind of like the iPhone 7 became obsolete when the iPhone 8 came out, right? That same concept applies. If the market value if the market value is lower than the purchasing cost, we call that the lower cost of the market. Market value in the lower cost market is net realizable value. Net realizable value is calculated by taking your estimated selling price and subtracting out your direct costs of disposal. Direct costs of disposal include the selling prices and any special advertising and selling administrative expenses. This stuff isn't very common. That's why we're going pretty fast through it. It's really not not very commonly utilized. Assuming that the following data about damaged inventory. Original cost was 1,000. Estimated selling price is 800. The estimated selling expenses is 150. If we apply the lower cost of market, the inventory is worth 650. How we got there? We took the estimated selling price and subtracted out the selling expenses to get 650. So that would be its realized value. Lower cost of market method can be applied in one of three ways. The cost of the market and any declines will be determined for each item in inventory, each major class of category, and total inventory as a whole. Here's an example. Inventory on the balance sheet. Let's see where we're at. I think we're pretty close to the end here. So all this other stuff is not as relevant. Okay, let's talk about inventory turnover. So very similar to what we covered earlier, another ratio that managers look at to understand if the inventory is helping the business to gain additional revenue, we calculate what we call the inventory turnover ratio. This measures the relationship between the cost of goods sold and the amount of inventory carried during a particular period. It measures the number of times inventory is turned into sold goods during the year. Inventory turnover is calculated by taking the cost of goods sold and dividing by the average inventory. Average inventory, as you know, is taking the two components of purchase inventory divided by how many times you purchased that inventory. Or also, well, I guess another way of saying it is you take your beginning balance of the year plus your ending balance of the year divided by 2. That gives you your average. Another ratio that we look at to understand how quickly we're turning over our inventory is the number of days sales in inventory. This measures how long it takes to acquire, sell, and replace inventory. To do that, we take our average inventory and divide it by our average daily cost of goods sold. To get your average daily cost of goods sold, you take your cost of goods sold and divide it by 365. To get your average inventory, again, you take your beginning balance plus your ending balance and divide by 2. And we're done. Yay! That's the end of chapter 6. Are there any comments, questions, or concerns for those of you who are left on the call that I can answer for chapter 6?
No, I thank you for explaining the balance sheet and how everything works. The documentation as far as what you're supposed to note when you jotting down the information on the sheets correctly. So and then I noticed that, like you said, everything when you do what you do on the left side, you must do on the right side. So if you have a credit, you also have a debit. So you have to just remember. I think with me, I just have to remember.
Yeah, you're absolutely right. So as long as you keep those key things in mind, you'll be fine. It's just a matter of knowing what those foundations are, knowing how to do those transactions, and that once you understand that those transactions flow into the financial statements, that's the whole point, right? And then once you get that down, everything else seems to flow together. Yeah, very good.
Okay. Okay.
Yeah, you got it. It's exactly right. You got the foundation down. Great. Are there any other comments, questions, concerns that I can help you with at this time? Or we feel comfortable? Good. Okay. Well, again, if you ever have any comments, questions, or concerns, please feel free to email me. You can schedule some time to meet with me through office hours in the classroom. To do that, all you do is go to your classroom, select office hours on the left side, and then select 30-minute session, and then select either Monday or Wednesday, whatever works for you, and then select a time to meet with me. And then I'll meet with you for that half hour. And you know, you can talk about whatever you want to talk about, and I'll help you out. So email, office hours, I'm available all the time. You could even call me. If I don't answer right away, just leave a message. I'll get back to you. You know, there's a lot of ways you get a hold of me. So again, for these sessions, we'll only meet on Tuesdays. We only meet on Tuesdays from like 11 to 1. We'll cover both chapters. And then the rest of the week is you working your hardest to get everything done on time, right? And that's kind of the name of the game. That's how the class will flow from here on out. So if you have any comments, questions, or concerns, please feel free to get me. Otherwise, I hope you all have a wonderful rest of your day and a great week ahead. Please stay healthy and safe. And if you ever need anything, you just let me know. I'm here for you.
I sure will. Oh, Professor, I got my book too. I wanted to let you know I got my access code. So
Yay! That's
and
wonderful news.
got my access code. So, but I'm going to wait till the 14 days. But I do have my access code, so I'll put it. I'm gonna get use their little free thing. But yeah, I do wanted to let you know I do have my
Great.
access code, so I'm good to go.
Wonderful to hear. I'm so happy. So go ahead and get in there and just start knocking everything out.
I sure will, sir. I sure will. You
Sounds
have
good.
a day also.
Thanks, Lakeisha. I appreciate you.
Thank you.
All right, thank you. Osman,
Thank
are
you,
you good? Osman,
Yeah, I'm good. I'm good. Thank you for the class.
wonderful. I'm so happy. Okay, so anytime you need anything, you just let me know. I'm here for you.
Sure. Thank you very much.
Great.
Have a great
Thank you. Take care. Have a blessed day.
bye.
Okay, thank you so much. Take care now.